Hello, everyone. The material we'll be covering today was prepared by Dr. Samir Al-Rishani with some AI support.
All right, today we're going to dive into what is, without a doubt, one of the most critical and, let's say, debated topics in all of Canadian tax law. We're talking about the General Anti-Avoidance Rule, or GAAR, as you'll hear me call it. This is really the government's ultimate tool for drawing that fine line between what's considered savvy tax planning and what it calls abusive tax avoidance. And that really brings us to the core question, the one that every tax professional, every business owner, and certainly every law student has to grapple with. When does being smart with your taxes cross the line and become a scheme that the Canada Revenue Agency can just shut down? Answering that very question is exactly why GAAR was created in the first place.
Okay, so let's get right into it. To really get a handle on GAAR, we first have to understand the world it operates in. You see, in tax, some things are black and white. There are very bright lines. But there's also this massive, incredibly challenging gray area. And that gray area? Well, that's where we'll be spending most of our time today.
So let's start with that bright line. On one side, you have tax evasion. This is straight up illegal. No ambiguity here. It's all about deceit, hiding income, claiming expenses you never actually incurred. This violates the letter of the law. And yeah, you can be prosecuted for it. Then on the other side of that bright line, you have tax avoidance. And this is perfectly legal. It's all about using the Income Tax Act as it's written to organize your affairs in a way that reduces your tax bill. Now, this idea isn't some newfangled concept. In fact, this famous quote you see here from a 1936 UK case, the Duke of Westminster case, has been a cornerstone of tax law for nearly a century. It establishes a really fundamental right. You are absolutely allowed to arrange your financial affairs to pay less tax as long as you're following the law.
But, and this is a huge but, this is where that gray area starts to creep in. What happens when a taxpayer follows the literal words of the law, the letter of the law, but does it in a way that just feels wrong, in a way that completely undermines what Parliament actually intended those words to do? Well, that's what we call abusive tax avoidance. It's that murky space between legal avoidance and illegal evasion, and it's precisely the mischief that GAAR was designed to stop.
And make no mistake, the stakes here are absolutely enormous. The Parliamentary Budget Officer estimates that Canada loses somewhere around $25 billion a year to these kinds of aggressive international tax strategies. Now, a number that big shows you exactly why the government is so focused on this gray area. This isn't just some academic debate. We're talking about billions of dollars for the country's tax base. So the big question is, how does the government even begin to police this gray area? Well, think of the Income Tax Act as the official rulebook for a game, GAAR. GAAR is the referee on the field. It's the rule that gives the ref the power to blow the whistle when a player uses some weird, obscure loophole that goes against the spirit of fair play, even if it doesn't technically break a specific written rule.
So how does our referee decide when to actually blow that whistle? Well, the Supreme Court, in a landmark case you'll hear a lot about called Canada Trustco, laid out a very clear three-part test. Step 1. Was there a tax benefit? That's usually the easy part. The answer is almost always yes. Step 2. Was this an avoidance transaction? Which really just means, was getting that tax benefit one of the main reasons for doing the deal? But Step 3 is the big one. Was the transaction an abuse of the tax rules? That is where all the legal battles are fought.
Okay, so that's the theory. But how does this test actually work in the real world? To see it in action, we're going to walk through a really important recent Supreme Court case, the case of Dean's Night. It's basically a masterclass in how GAAR gets applied to a very, very sophisticated tax plan. So here's the setup. You had a company, Dean's Night, that had racked up a staggering $90 million in business losses. Now, in the tax world, losses like that are valuable. You can use them to shelter future profits from being taxed. But there's a catch. The law says if someone new acquires control of the company, those valuable losses get wiped out. So a very complex plan was put together to sell the company to a new, profitable owner, all while technically avoiding the legal definition of an acquisition of control. The entire case really boiled down to one single word: control. You see, the law has a very technical definition of control that's based on who owns the majority of voting shares. We call that de jure control, or control in law. The lawyers for Dean's Night built this incredibly clever plan to sidestep that specific trigger. But the CRA came back and argued, hey, wait a minute. If you look at the reality of the deal, what they called de facto control, or control in fact, the new owner was clearly in charge. They argued the spirit of the law had been broken, even if the letter hadn't. So what happened? Ultimately, the Supreme Court's majority sided with the CRA. They looked right past the technical legal structure and focused on the economic reality of the situation. As the court itself put it, the plan achieved the functional equivalent of a change in control. The key takeaway here is huge. Even though the plan meticulously followed the letter of the law, it completely defeated the law's purpose. And because of that, GAAR was applied and poof, those $90 million in losses were denied. Now, that Dean's Knight decision sent a very clear signal from the courts, and in response, Parliament has now stepped in to put even more teeth into GAAR. The 2024 amendments that have just come through, well, they've seriously raised the stakes for anyone designing or using sophisticated tax plans here in Canada. You know, GAAR has really been on a long journey. It first appeared back in 1988, and it started as a pretty broad principle. Then, the Canada Trustco case in 2005 gave it that clear three-part legal framework we talked about. The Dean's Knight case, just in 2023, reinforced its power to look at the spirit of the law. And now, in 2024, the government has gone and amended the law itself, adding brand new tests and, for the very first time, some major penalties.
Okay, one of the single biggest changes is this new economic substance test. From now on, the CRA and the courts are going to ask a very simple but very powerful question. Does this whole transaction have a real business or economic purpose, or was it just about getting a tax break? Now, if a transaction is found to be lacking real economic substance, it doesn't automatically mean it's abusive. But let's just say it's now a very, very strong strike against it.
So you're probably wondering, what does a lack of economic substance actually look like? Well, the new law gives us some pretty clear red flags to watch out for. We're talking about things like a circular flow of funds, where money just goes in a circle and ends up right back where it started, or offsetting financial positions that cancel each other out, removing any real economic risk or chance for profit. And a really big one is when the expected tax savings are way, way bigger than any potential non-tax profit. These are now explicit warning signs written right into the Act.
And here it is. This is the change that has the entire tax community on high alert. For the first time ever, there is a direct, painful penalty for losing a GF fight. If GR applies to your plan, and, this is key, you didn't proactively tell the CRA about it beforehand, you will now face a penalty of 25% of the tax you tried to save. This adds a huge financial risk to the equation that simply never existed before. So, with this much tougher new environment, what are the practical takeaways? Right? What does this all mean? How do you navigate this new landscape if you're a business owner or a tax advisor trying to do the right thing?
Well, the good news is the government has provided some guidance on what it still considers safe. A lot of common, standard tax planning strategies are still perfectly acceptable. For example, estate freezes, which are a common way to pass a business to the next generation, are still fine. Something called corporate purification, which is a process to clean up a company's assets to qualify for the lifetime capital gains exemption, that's also still okay. But, and this is important, the government has explicitly flagged other strategies, like certain capital gains strips designed to turn high-tax dividends into lower-tax capital gains, as being right on their radar for a potential GAAR challenge.
And what about avoiding that new 25% penalty? How do you do that? Well, there are two main safe harbors. The absolute surest way is through proactive disclosure, basically telling the CRA what you're doing up front through their new reporting rules. The only other way is if your plan is identical or almost identical to something the government or a court has already publicly signed off on. But I have to stress, that is a very, very high bar to clear. Just being similar is not going to cut it.
You know, this quote really gets to the core attention of GAAR. As the tax experts at Friedland Law point out, a rule that's flexible enough to catch any clever new loophole that someone can dream up will, by its very nature, create uncertainty for taxpayers who are just trying their best to follow the rules. You can't really have one without the other. It's an inherent trade-off.
And of course, for us to understand these incredibly complex amendments, we have to rely on the detailed analysis of experts in the field, like the excellent work being done by firms such as Friedland Law.
So, this leaves us with a final question for you to really think about. The government's goal here was to draw a clear line and to scare off abusive tax planning. They've definitely built higher fences and they've posted much bigger warning signs. But in doing so, have they actually made the line clearer, or have they just moved that line into a deeper, more uncertain fog for everyone else?